All right, everybody. Who's excited to get our panels kicked off today? I'm excited about tokenized equities. It is one of the hottest topics today. I believe it's now being quoted as going to be the largest size of volume for RWAs within the next year or two. That's why we're going to have to get into this panel with some of the best folks that are tokenizing equities today. We have none other than Giang from Securitize, Anna from Dinari, Alex from Galaxy, Arush from Alpaca, and last but not least, Andy from the Rollup moderating this session. Thank you, everybody.
Alrighty, guys, day 3 of Tokenize This here in New York City at the Glasshouse. This is the Rise of Tokenized Equities panel. I'm Andy. I run a media show called The Rollup. We are live from the Empire State Building every single day, covering a lot of these topics and more. We have an amazing panel today. We'd love to just do a round of introductions. And what, if you've checked the price of Bitcoin today, Giang?
I have not checked this morning, but I think last I looked, it was high 60s. Last I looked. But intro about myself, Giang, I'm head of issuer growth for Securitize. Securitize is a leading tokenization platform. We work with the world's largest asset managers and firms to tokenize their stocks and funds and bring them on chain in a regulated and compliant way.
Hi, everybody. I'm Anna. I'm Chief Business Officer at Dinari. We are an end-to-end tokenization platform, primarily distributing through regulated channels internationally and soon in the US. We focus primarily on Reg NMS shares, so public equities. And no, I did not check the price of Bitcoin this morning.
I'm Alex Thorn. I'm head of research at Galaxy. We're one of the world's largest OTC dealers and asset managers in crypto. We tokenized Galaxy stock as an issuer-sponsored security last summer. And I checked the price of Bitcoin about 15 seconds ago, and it was 58K.
I was way off from the last time I checked.
I checked, it was 63 last, so I don't know. My eyes are on gold. That's my prediction for the next 6 months. I'm Arush, head of digital assets at Alpaca. We are a API-first brokerage, and we are the underlying tokenization infrastructure for many tokenized equities. We have around 94% market share of the publicly, so like the tokenized equities that of US public mega caps. So basically the majority of economic activity that is happening with tokenized equities today is powered by Alpaca. Yeah.
Awesome. For some context, for those who are kind of somewhat new to tokenized equities, there's been kind of this evolution of how this process has started. You know, it really kind of picked up with stablecoins over the last 3 to 5 years, and we've kind of almost, in my view, gone down the risk curve in terms of tokenized deposits. You know, all the way down to tokenized equities being a really, really popular version of tokenized assets now. Just 2 Fridays ago, we had the SpaceX IPO. That happened on a Friday morning. Started trading at about 10 a.m. on that Friday. And that weekend, there was the highest amount of tokenized equity trading on chain, I believe, ever in a short period of time. There was a lot of perps trading and a lot of spot trading on those tokenized equities. I feel like from my perspective, this was a bit of a tipping point for the on-chain environment, just seeing the amount of demand and trading activity on the specific single stock on a weekend and after hours. I guess to start off, guys, what does the launch of the SpaceX IPO on chain and seeing the massive rise of demand and trading activity for a single stock, what does that signal to the market about the level of demand that there is to trade these assets 24/7 after hours, and really in a global and permissionless fashion? Just kind of set the stage here on the context of where we're at. And maybe Giang, we can start with you.
Yeah, I mean, there's definitely a lot of interest behind that SpaceX IPO, largest IPO ever. There's the largest allocation to retail ever. So there's definitely a lot of demand behind it. And you see that, translates into retail investors around the world who wants to be able to allocate and be able to get a piece of that IPO. And so, you look at the overall public markets in the US, it's 75 trillion. So, even a small percentage of that moving on chain is 10 times more than the overall tokenized RWA market today. So, this is really, to your point, a tipping point on people wanting to get this access to these vehicles in a faster, cheaper, easier way and a better product experience. But I think the importance, what it also shows is there's a lot of vehicles that we're saying they're going to give a tokenized exposure to SpaceX, but there's definitely cases where they were not able to receive the allocation for SpaceX shares, and ultimately token owners did not receive any SpaceX exposure. So it really comes back to, what does it mean to own the token? What does the token represent? And us, along with I think a lot of folks on this panel, is very much about, you want the token to have true ownership rights and benefits as the traditional shares, so that investors who are buying the tokens has that clarity in what they own, and that really is what builds trust in both the investors and the issuers, so that people can get comfortable owning the tokens and investing into the token going forward and accelerating the growth of tokenized equities.
Fully agree with you. So there's maybe two parts to all of this. So one is there's the access story, right? And I think a lot of what we've seen with SpaceX is this real example of how many people in the world really, really want access to US capital markets. And I mean, I get questions all the time about Korean capital markets. Like, people across the world want access to different things that they don't currently have. So this is kind of stage one of demonstrating the point that people want stuff. To your point, though, Giang, it does matter what you're buying, right? There's many different versions. If I may, just like one step back, are we all familiar with the different models of tokenization here? Because there are different approaches. Yes, no, I won't talk about it if everybody knows. But it does make a difference, right, what you're buying. Having some kind of claim on the traditional security, having a price exposure, it's good to know kind of what the purchasing experience is. And I do think that we are going to see kind of a rise of sophistication about what it is that we are buying and owning, which will be an interesting transition to see in the market. I think we're already seeing it to a large degree. But it is a great example, SpaceX, of, this is why we're doing this. This is an unlock of demand. It's a new revenue channel for people like asset managers, and it's a good demonstration of why tokenization kind of makes sense.
I'll just double click on the point about what is the thing that you own? What is the token actually representing? I think the biggest story of the SpaceX on-chain IPO was that XStocks failed to deliver tokens to BitGet and Bybit and Kraken and Binance, and all of them had to tell their customers, and you probably saw this on Twitter, they sent emails and saying, oops, sorry, like, we thought we were going to get these shares and we didn't. That's because they're relying on an intermediary, and the potential token holder was going to have no direct relationship with the issuer of the token. And this is the clear fault line on the regulatory discourse in the United States about what tokenized securities should be. You might remember maybe a month ago, Bloomberg reported that the SEC was internally deliberating how to issue their so-called innovation exemption for tokenized securities, absolutely leaked by someone at the commission who opposes third-party wrappers, which is what XStocks is, and I'm going to talk about them since they're not repped on the panel here. And they were opposed to that, almost certainly, and they leaked that the commission was considering allowing third-party wrappers to benefit from the innovation exemption, and that caused a huge firestorm, and then the SEC publicly said they were delaying their release of the innovation exemption. That whole question is at the core of how tokenized securities are meant to look in the US. It's the reason why XStocks and Ondo don't offer to US customers. It's the reason why ours has an allow list and can't be moved to an address that we don't previously onboard. We're all waiting for the SEC to make a determination about that distinction. And I thought the SpaceX the failure of X stocks to get allocation and therefore pass it to those exchange users is a very iconic example of the problem that the market is facing. And a lot of it, like I said, is just due to lack of regulatory clarity. We're going to get that clarity one way or another. It's not clear what the SEC is actually going to say yet, but we're waiting with bated breath.
Alex. I take the opposite view. I don't see any difference in what happened with X stocks receiving allocation to what happened with Charles Schwab not receiving their allocation. So crypto Twitter people tend to be a lot louder than TradFi traders, I guess, and there's not a lot of attention on X, but if you do search for people that were not able to get filled on Charles Schwab, on Fidelity, this was absolutely nothing to do with the token. The fact that a token was issued off the back of a share. In fact, Dinari SpaceX token is also, the share is held in custody and a token is issued off the back of it. So the model of tokenization, I don't think has anything to do with the way the SpaceX, tokenized SpaceX offerings were handled. I think it had everything to do with the insider cabal of how IPOs work. So the underwriters of SpaceX IPO were Goldman Sachs, Morgan Stanley, the large banks. E-Trade is owned by Morgan Stanley. All of the allocation to retail was given, most of it was given through E-Trade. They don't want to have their competitors access to the hottest IPO of the year, and it's as simple as that. And that was planned from the beginning. When Elon decides which underwriters he's going to go to, the underwriters get together and they form a package deal of okay, we're going to control the supply, we're going to distribute to this set of broker dealers, we're going to put restrictions or penalties on those broker dealers if they produce too much sell pressure, and that's how they engineer the 20% price pop on the day one, which is, considered the exact perfect pop for an IPO. That's so no surprise it popped 19% on the first day, and it was considered the perfectly engineered IPO. So I think that narrative is false about the tokenized wrapper models being, the SpaceX IPO being, exemplary of any kind of faults with the wrapper model.
Anna or Giang?
Go ahead.
To be sure, there's other risks with the wrapper model, the synthetic model. To your point, Arush, so Dinari innovated what's called the custodial model, where the token is a twin of the security. We had a very boring IPO day. It was fun, but it wasn't eventful, put it that way. But there is a traditional side aspect of this, right, where IPOs function in a certain way. And I'd be very curious to hear your thoughts on whether you think that changes at all in a primary issuance model if someone's floating their whole cap table in token form.
Yeah, and I think we're talking to a lot of banks and others about what does that opportunity look like to have tokenized IPOs? What does that look like? But I think there's going to be we're really in a place where TradFi and DeFi is at that bridge, and we're going to see offering that will go in tandem with both off-chain shares offering and on-chain shares, and will still allow for that price discovery and that price formation the night before, and ensuring that investors have the best experience possible. And I think, Arush, to your point, this IPO is very oversubscribed, and there's a lot of people who wanted allocation at the IPO but wasn't able to get it. But I think the one thing that is also important is disclosures about this information, like the Schwabs, the retail brokers. When they do make these subscriptions available for their clients for the IPOs, there's a lot of information that they're laying out in terms of you might not get filled, you do have to hold it for a certain amount of time if you want to continue to participate and so forth. And a lot of these disclosures about what are the risks and what is your likelihood of being able to get the allocation. So I think that's also really important when it comes to tokenization. exactly what is the risk if you're going to be holding these tokens, whether they're issuer sponsored or custodial entitlement or wrappers, so all of that laying out so that investors can have an educated decision when they're making their purchases.
Can I ask a question of you guys? So I'm curious what you all think. Say we go to this world where we have custodial tokenization and primary issuance tokenization, and IPOs are happening, off of blockchain rails essentially. Does there start to become a global competition for IPOs? I mean, obviously we're sitting here in New York. We have the assumption that everybody wants to IPO on NASDAQ or NYSE. Do we start seeing a global competition set for, well, we're going to change this cabal mentality and give you something even better to IPO over here in Seoul or in Hong Kong?
I think with the way, this is like a bit of a contrarian take too, but the way that ICOs have worked or developed over the years, I think is tending towards a more perfect version of how IPOs should work, like a fair launch or a fair allocation or some kind of it's the same with World Cup tickets, or you know what I mean? There's always a scandal with FIFA, right? Because there's so many people that want the tickets, and there's only their systems don't work. They don't really have a good technical system to do a fair allocation. And I think ICOs are like the way that, eventually I think this will be the mechanism that does a fair launch. And I think the TradFi IPOs will probably end up, talking 5-10 years from now, I think they're going to take a lot of inspiration from the way ICOs, good ICOs work.
I think it's a really good question. I wonder more about whether on-chain can compete with NASDAQ and NYSE as the launch venue, whether there's some form of decentralized underwriting that would occur. Obviously, the big banks do a lot more than simply help the stock get listed. So I think it comes down more to whether or not capital can show up and purchase these newly issued shares. But I do think, again, here's an area where we expect the SEC to tell us a lot of information. They're working on a separate thing called Reg Crypto, which is likely to be some form of instantiation of Hester Peirce's Safe Harbor 2.0 proposal, which is literally a regulated ICO type format. It's not clear, again, exactly what that means. Maybe it will apply more to newly issued crypto assets than tokenized securities, but we're going to get some form of information from them on this.
And maybe my roots are showing because I spent over the past decade at all three of the largest exchanges. So I was most recently at NASDAQ, was with New York Stock Exchange and SIBO prior to this. So, maybe I'm biased, but I do think, these exchanges in the US capital markets are the biggest in the world because there are investor protections and there are liquidity mechanism and price formation that is occurring on U.S. markets that make the IPO go as seamless as possible. We make sure that investors are able to access that capital and that liquidity in a very seamless way. So while I think tokenization will make it easier for global investors to be able to tap into the different capital markets around the world, I think it would be, but these rules and regulation that are in place are not all necessarily bad. I think smart deregulation makes a lot of sense, but there's definitely things that we've lived through, many financial crises, many scandals that made these rules be in place in the US so that investors are protected for these things occurring again. So I think that it's still going to be a natural gravitation towards listing in the U.S., but does tokenization become a better path than ADRs or other capital raising for global companies?
Yeah, I think we spoke a lot about capital formation side. I think there's also a whole other conversation about the pre-IPO kind of perps market and price discovery as well. I think that's very interesting, kind of a little bit adjacent to the tokenization conversation. Another kind of question that I think folks in the audience or folks who would be listening would be wanting to know is kind of we're in this era of tokenizing a lot of these equities and bringing them on chain, and it's very much happening. But there's this resounding, then what? There's this kind of like purposelessness that needs to be addressed in the room, I feel like, with tokenization at large. And so I think there's a lot of interesting experiments that are possible and that are happening, from collateralization of tokenized equities to vault and yield strategies, or obviously the efficiencies of 24/7 trading, after-hours trading with good liquidity. How do we answer the then what question for large-scale asset managers, institutional investors, and then eventually the retail investor who also is going to ask that? What is that answer? What does that look like? I'm sure you guys have all different answers.
I'll be quick. I think that the then what is like so what? Why are we doing this? And I think it's really about just having a global platform where you can have one wallet and trade anything, right? All stock markets, all asset classes. And it's crazy that in 2026 that doesn't exist today. And I think the technology that we need is blockchain rails and 24/7 fiat rails to make it work.
Satoshi said that the root problem with traditional currency is all the trust that's required to make it work. Unfortunately, he didn't say the root problem with fiat currency is that we don't have a better back-end technology for stocks, but that is what we're building here. And one of the ways I think about it is I've been interested in Bitcoin since 2013 and working on crypto full-time since 2016. And I really only see like 3 product market fits here. You've got Bitcoin. People, regardless of what you think about it, people all over the world love to buy and own Bitcoin. Stablecoins have very clear product market fit. And then DeFi applications are very, very useful to a lot of people. The problem with the DeFi today is that most of the assets in them suck, right? Who cares if you can do perfect, leverage and risk calculations if the underlying is like Dogecoin, right? It's not that impactful to the world. So one of the things I'm so excited about with tokenized securities is that you get high quality assets using the high quality infrastructure that has been built. And so yes, it could mean that you can more frictionlessly buy and sell any asset in the same wallet. I agree with that as a huge unlock. It could mean that you can borrow and lend your assets much more seamlessly and in a sovereign manner. It can mean all of those things, but it's almost like crypto on chain has speed run an entire history of financial services, but they just don't have access to the best assets. And that's what excites me about real world assets on chain and tokenized securities, in particular tokenized equity securities, which are the most exciting assets in the world, stocks in my opinion. And so, I think you just don't quite know. It's like, what if you gave the designers of the stock market open source software, right? And that's open source software has revolutionized technology. It's revolutionized the internet. Obviously, blockchains are, for the most part, all open source and designed by the world. I think you can't quite even picture the unlocks that are coming.
I'll add a third one. So yes, and I think there's an aspect to this also where you're bringing blockchain-based or crypto-native technology into the kind of normie world, if you will. And that does not mean necessarily self-sovereign DeFi. It just means, hey, I want to be able to have automated margin or the opportunity to hypothecate my shares. These are kind of utilities that I think people would like to use, and that I think those intermediaries that exist today that want to serve customers, which, I mean, a lot of customers still want to trust that they can pick up the phone and call like a customer service person, right? I would argue, though, that for me, the most exciting thing yet to come is asset management. And the promise for me of being able to put multiple assets classes together in one highly scalable product. One that we did last year with S&P was the Digital Markets 50 Index, which is a token product that allows you to direct index into an S&P index of 35 equities and 15 crypto major tokens. I think that is like baby step number 1 in a world in which you could invest in multiple different asset classes in one product at a low cost. You cannot do this right now. And on traditional rails, it's very difficult to deploy, whether it's an ETF or another type of product that has multiple asset class constituents. So, if you're interested in gold, I think you mentioned gold, Arush, earlier, you could have the commodity and the public equity of a mining company and the private debt of an exploration company and so on and so forth. In a single product, you could also hyper-personalize portfolios, but you kind of need some rails to make that scalable, right, for the enormous number of retail investors that exist. But I think that's some of the most exciting yet to come stuff in the industry.
Yeah, and I agree. It's hard going last when they have such great responses. But I think ultimately investors don't care about the plumbing as much. Like they just want to be able to, to everyone's point, access good investment vehicles that they're not able to do elsewhere. Have a very easy experience. Have utility to the tokens beyond buy, hold, sell, which is what blockchain enables. But right now the experience is still kind of clunky. So there's a lot of work that's being done to improve that experience across the industry. We're seeing a lot of institutions investing into their digital assets team and their digital asset infrastructure so that there's better liquidity pools so that these assets can trade seamlessly and be more connected together. So all of that is coming, and I'm excited for when, assets can be traded very easily. There's more liquidity providers that are coming on chain and providing, those tight spreads and ultimately having more quality assets on chain. That's what we're focused at Securitize, is building that market, but also working really closely with issuers and asset managers to bring products that has demand on chain to be used.
I'm gonna just add one more thing because you inspired me. I think the whole point of what crypto does is composability. Right? It's permissionless composability. We're opening up the financial system for builders to compose different assets together. And if we're not doing that, if we're not doing it in the service of permissionlessness, what are we doing here?
Agreed. Alex, just wanted to, double click on one of your points. It's something that we've been harping on our show every single day as we kind of just look at the scene of investable assets inside of the crypto landscape. We keep talking about how this industry has been kind of thinking about the TAM of what we're doing on chain within the lens of the $150 billion in DeFi today, as well as the $2 to $3 trillion of total market cap. But really what's happening through this conversation and through all of the work from these teams up here is that we're tokenizing trillions of dollars of assets in the next 5 years, and those will be on-chain. And so the total addressable market of the on-chain economy is much larger by orders of magnitude than it is now. And so, we've been kind of harping on there's certain DeFi protocols that look interesting here. There's certain perps exchanges. There's certain spot trading venues. There's certain oracles, bridges, whatever it could be. So my question to you, Alex, is just if this tokenization thesis is correct, what we're talking about here with equities and other types of assets, which companies win the most? Who do we look at from an investor mindset? Who wins the most here?
Yeah, that's a very good question, Andy. The easy answer is no one quite knows yet, and there's a lot of people and companies working on either building it or building on it or looking to use it in some way. One thing I think about, like when I talk to regulators in particular about, or big banks about tokenizing securities and trying to assure them that it's really more about a great convergence between crypto and TradFi than some sort of attack that crypto is enacting on TradFi. If you look at anybody in the audience know what the largest Uniswap pool is by assets? Does anyone know? Would you guess? If I told you it was ETH USDC, would you guess the number? Do you know how big it is, Arush?
I don't. I was going to say like USDT, USDC or something.
Yeah, no, it is ETH USDC, but it's only 100 million. So like if you go in to buy $2 million of ETH in Uniswap, you're going to get slipped like crazy. So in fact, if you look at the on-chain spot traded volume, it's only about 20% of the total crypto traded volume. Still 80% of crypto traded volume is on centralized exchanges. I kind of think of that as I have no idea whether it will get there, but a reasonable heuristic as to how much volume tokenized securities might trade on-chain versus at NASDAQ and NYC. So I'm not And by the way, I think that would be revolutionary if it even got close to that, to be clear. But again, like no one, I don't think, is arguing, nor should they, that like 100% of stocks are going to trade on chain. I think you've got different venues for different purposes. You know, if you just tell your broker, go ahead and buy these shares, great. If you're sophisticated, if you're a mutual fund, you trade in a dark pool, there's ATSs, there's all these different ways to trade. And I do think for some investors or their brokers, in some circumstances, on-chain trading will be very valuable to them. But it won't be all of it. And so to your direct question, like, what's the most valuable company in traditional securities? Like, look at the big banks. I mean, they're okay. JPM's okay. It's not that valuable. Who makes more money, JPM or Citadel, right? Like, I think it's very likely to look similar to traditional securities. It's really going to be the active trading market makers that make a lot of money but of course there will be the infrastructure firms, you know, maybe Securitize and Dinari and Alpaca are the new big banks of on-chain finance. No one quite knows. But you're just looking at the traditional stack and maybe mapping it, you know, like is MEV the new HFT, right? Like, and does a jump in a Citadel become the, you know, jump in Citadel of on-chain securities? You don't quite know. I think people are building each of those.
I think you're right. We don't know who's going to win, but I think I guess I could say who's going to lose. And just someone once told me the entire financial system is just a series of middlemen in between your 401k and small to medium businesses, right? And like I kind of think of this, like everything that we're doing in the financial system, most of it is like just middlemen fat that needs to be cut out of the system. And blockchain and like tokenized equities is literally deleting a lot of unnecessary steps. You know, these steps were introduced because of all the different counterparties within a trade, and now we're eliminating like the counterparty risk in the system. So there's no need for all these additional steps, and I think we're going to see like the big incumbents lose. Like, I think the CME loses. I think the NYC NASDAQs of the world, who are at least the part of their businesses that depend on selling data, I think that's gone, because in the crypto world, like data's free, right? You can't trade without market data. So all the exchanges make the data free. It's like a no-brainer, right? What else? Like, okay, so CME. I think you're right about the market makers. Like the fragmentation is going to increase, but the market makers are amazing at stitching together liquidity. They're so good at it. Like, our financial system is so efficient at solving that problem. So I think they have a key role to play. But they deploy balance sheet, right? So it's not exactly a zero, like a guaranteed win. But I think, yeah, a lot of these incumbents are going to be deleted, and that's the point of this. Like, everyone should be able to invest their hard-earned capital, and the middlemen should not be taking, percentage points.
Sort of semi-agree, but semi-disagree. I think it's, in some cases, I don't think that this completely eliminates counterparty risk. DeFi certainly has not been 100% successful at eliminating risk, right? That's not a controversial statement. And there's, especially, when, again, you have different standards for how to do things, you have different products that are floating around in the market. There are risks that come with permissionless markets that don't entirely exist in the same way in regulated markets. Again, I don't think this is controversial. You do eliminate some of this, look, everybody's looking at this technology as a way to potentially disintermediate everybody else that they deal with, because, to your point, you might have some IP or you have a product, and there's several people down the chain that are eating away at your margins on that product. So there could be I think there could be really interesting shifting around of that financial stack. And certainly we hope that we see a flattening of infrastructure. Like if you're familiar, I mean, there's a whole mess of infrastructure between you and where your securities that you're buying and selling actually live. And blockchains are very good at flattening those types of things. But I don't necessarily see a world in which you don't have regulated counterparties in the middle that are taking responsibility for what happens to your assets.
Yeah, I mean, I think it's not going to be a zero-sum game. Like, I think the pie is going to grow, and firms are going to, especially traditional focused firms, are going to have to adapt and change potentially their business model, their revenue model. And I mean, I do feel like it's an evolution. Like some of these intermediaries are there to serve a good purpose, to again, protect investors. They're definitely going to have to rethink their revenue model and become more efficient or cost-effective to adapt with the technology changes. But maybe you say Vault becomes the new financial advisors or asset managers. So firms become, they evolved into a new form that can provide the services in a more efficient and cost-effective way for all.
I'll give you another one. Okay, so we talk a lot to public market companies. Not a lot, but like one thing that these guys tell us is that the US capital markets are broken for small caps. And the reason is there's a lot of like shenanigans that happen with short selling and like naked shorting. And it's because there isn't like a transparent system today of like where's all the circulating supply, who's pledging, locates. There isn't like a centralized reservation system. So I think if we solve all of this with the transparency that blockchain brings, the US capital markets will finally start to work again for small caps, and I think that's a big win.
Any audience questions? Anything? All right, guys, give it up for your panelists. Thanks for the time. Awesome.
Thank you.